A repossession happens when you can't pay for something you bought with credit. This can be a very stressful experience for anyone involved. When you make a purchase using credit, you agree to pay back the amount over time. However, if you fail to make these payments, the lender has the right to take back the item you bought. This means you stop making payments and the debt starts to accumulate. Ignoring these bills won't make them go away. In fact, it only makes the situation worse. The lender can take the item back through a process called repossession. This is often done without any court order depending on the terms of your credit agreement. This is commonly referred to as a repo. The most familiar example of a repossession is when a car is taken back by the lender. Cars are common items that get repossessed because they are often bought with loans. If you miss several car payments, the lender can send a tow truck to take your car away, but lenders can take back other things too. These include houses, furniture, or electronics. Essentially, any item bought on credit can be repossessed if you fail to make the agreed payments. For example, if you bought a couch or a television on a payment plan and stopped paying, the lender could come and take those items back. When a lender repossesses something, it gets reported to credit bureaus. These bureaus collect information about your financial activities and create credit reports. Credit bureaus collect this information and create credit reports. These reports are used by lenders to assess your creditworthiness. Your credit report shows how well you handle debt and make payments. A repossession on your credit report is a red flag for future lenders. A repossession on your credit report is bad. It indicates that you have failed to meet your financial obligations, which can significantly lower your credit score. It tells lenders you don't pay debts. This can make it very difficult to get loans in the future, as lenders may see you as a high-risk borrower. This can make it hard to get loans in the future. Not only will you struggle to get approved for new credit, but you may also face higher interest rates and less favorable terms if you do get approved. Understanding repossession and its consequences is crucial. It can help you make better financial decisions and avoid the stress and complications that come with losing valuable items and damaging your credit score. Your credit score is a number that represents your creditworthiness. It's a crucial figure that lenders use to determine how likely you are to repay borrowed money. Essentially, it tells lenders how risky you are as a borrower. A higher credit score indicates that you are a low-risk borrower, which can make it easier to get loans and credit cards with favorable terms. Conversely, a lower score suggests higher risk, making it more challenging to secure credit. A higher score is always better because it opens up more financial opportunities. It can lead to lower interest rates on loans and credit cards, saving you money in the long run. However, a repossession can significantly lower your credit score. This drop happens because a repossession indicates that you failed to repay a loan, which is a red flag for lenders. When you don't pay back a loan, it shows up on your credit report as a negative mark. This can make lenders wary of offering you credit in the future. A lower credit score makes it harder to borrow money. Lenders may deny your applications for new credit or loans, or they may offer you less favorable terms. If you do get approved for a loan, you might have to pay higher interest rates. Higher interest rates mean you'll pay more over the life of the loan, which can strain your finances. This is because lenders see you as a higher risk. They charge higher interest rates to compensate for the increased risk of lending to someone with a lower credit score. A repossession can stay on your credit report for up to 7 years. This long-lasting impact can affect your ability to secure credit for a significant period. This can make it hard to rent an apartment, as many landlords check credit reports before approving rental applications. A repossession on your report can be a red flag for potential landlords. It can even affect your job applications. Some employers check credit reports as part of their hiring process, and a repossession can be seen as a sign of financial irresponsibility. You can try to remove a repossession from your credit report. Start by gathering all relevant evidence. This includes loan documents, payment history, and any correspondence with the lender. Contact the credit bureaus and dispute the repossession. Make sure to provide a detailed explanation of why you believe the repossession is incorrect or unfair. Write a formal letter to the credit bureaus explaining your situation. Clearly state why you think the repossession is wrong and include any supporting evidence. This letter should be concise but thorough, outlining all the key points that support your case. Provide all the evidence you have gathered to support your claim. This might include payment receipts, bank statements, or any other documents that can prove your point. The more evidence you provide, the stronger your case will be. Once the credit bureau receives your dispute, they are required to investigate. This process can take some time, so be patient. They will contact the lender to verify the information you have provided. In addition to disputing with the credit bureaus, you can also try negotiating directly with the lender. Sometimes, lenders are willing to work with you to resolve the issue, especially if you have a good payment history otherwise. Ask the lender if they would be willing to remove the repossession from your credit report. This can sometimes be done as a gesture of goodwill, especially if you have paid off the debt or have made arrangements to do so. This process is known as a goodwill deletion. It involves writing a goodwill letter to the lender, explaining your situation and requesting the removal of the repossession from your credit report. Removing a repossession from your credit report is not an easy task, but it is worth trying. With persistence and the right approach, you may be able to improve your credit score and financial future. Once you deal with the repossession, focus on your credit. Make all payments on time. This includes credit cards and other loans. Try to pay down your debt. The less debt you have, the better your credit score. Check your credit report regularly. Make sure it is accurate. Remember, a good credit score takes time to build. Be patient and keep working at it. You can improve your credit over time. Gap 3S. Your credit report is a detailed record of your credit history. It includes information about your credit accounts, payment history, and any negative marks like repossessions. Understanding your credit report is crucial for maintaining good credit. Regularly check your report for errors and dispute any inaccuracies. This can help improve your credit score over time. Gap 3S. Building credit takes time and effort. Start by opening a credit account, such as a credit card or a small loan. Make sure to make all payments on time and keep your balances low. Over time, this will help you build a positive credit history. Remember, consistency is key. Gap 3S. If you have unpaid debts, you may be contacted by debt collectors. It's important to know your rights when dealing with them. Always ask for written validation of the debt and keep records of all communications. If you believe the debt is not yours, dispute it with the credit bureaus. Handling debt collectors properly can prevent further damage to your credit score. Gap 3S. Credit utilization is the ratio of your credit card balances to your credit limits. It's a key factor in your credit score. Keeping your credit utilization below 30% is recommended. This shows lenders that you are responsible with your credit. High credit utilization can lower your credit score, so try to pay down your balances as much as possible. Music, hopeful, determined, investigative. Gap 3S. Building and maintaining good credit is a long-term process. Develop a strategy that includes paying bills on time, keeping credit card balances low, and avoiding unnecessary credit inquiries. Regularly review your credit report and address any issues promptly. Over time, these habits will help you achieve and maintain a strong credit score.